Welcome back to our channel, Mastering Investments. In today's video, we're diving into an exciting topic, making $100 a day with dividend stocks. If you've been searching for a sustainable way to generate passive income, dividend investing might be the key to unlocking your financial goals. So, let's jump right in and explore the strategies that can help you achieve this target. Dividend stocks are an excellent way to earn regular income from your investments. Unlike traditional growth stocks that rely on share price appreciation, dividend stocks pay a portion of their profits back to shareholders in the form of dividends. By strategically building a portfolio of high-yield dividend stocks, you can generate a steady stream of income that can add up to $100 or more per day. We think that the best dividend stocks aren't simply the highest dividend stocks. Instead, we suggest investors look beyond a stock's yield and instead choose stocks with durable dividends and buy those stocks when they're undervalued. Looking for the most yield-rich areas of the market can often lead you into troubled areas and dividend traps, companies that have a nice-looking yield that is ultimately unsustainable. You have to screen for dividend durability and reliability going forward. First up, we have Verizon. This cheap dividend stock, which is also the third largest holding in the index, is trading a whopping 40% below fair value estimate of $57 per share. We think the market is overly focused on Verizon's challenges to keep it trading at a fair value. As you can see, Verizon's dividend yield is sitting at 7.67%, meaning for each share you own, you would be looking at a $2.61 dividend yield per year. Secondly, Pfizer. This is one of the more widely held dividend stocks among top fund and asset managers. We don't think the market fully appreciates the pharmaceutical giant's ability to offset major patent losses over the next 5 years. The company targets close to a 50% payout in dividends as a percentage of normalized earnings, on track for a mature industry. Pfizer's dividend yield is at 4.53%, leading to a $1.64 yield per year for each unit you own. Although this is a lower percentage than Verizon. Always remember to diversify. Comcast is our next pick. While broadband customer growth is anemic and NBC Universal is challenged, we think Comcast is well positioned to limit broadband share losses and enjoy solid pricing power. Comcast instituted a dividend in 2008 and has increased its payout by 17% annually, on average. We think the balance sheet is sound, and shareholder returns are generally appropriate. Comcast's yield is the lowest of our picks today. But with how strong the company is, we think this is very appropriate. Wells Fargo is our next choice, and it's the only bank on our list of cheap dividend stocks. During the second quarter, Wells Fargo's net interest income outperformed despite rising expenses. Wells Fargo's balance sheet is strong and the bank's current dividend strategy is very appropriate. Wells is doing a fine job on the share repurchase front, too, buying back roughly 2.6% of its outstanding shares this past quarter. Another lower yield on our list, although this is the only bank on the list, and like I said before, diversification is always a priority. In our opinion, this is a very good pickup. Next up, Medtronic. This is another cheap dividend stock on our list. The largest pure-play medical device maker is a key partner for its hospital customers, thanks to its diversified product portfolio aimed at a wide range of chronic diseases. Medtronic's plans to spin off its patient monitoring and respiratory innovations businesses will only help the company pivot more toward faster-growing markets. Medtronic has raised its dividend for 46 consecutive years. Medtronic is one of the more expensive stocks on the list. With a comfortable and healthy 3.2% yield, you would be looking at $2.76 per share. Gilead stock is another cheap dividend stock in the healthcare sector. The company generates outstanding profit margins with its HIV and HCV portfolio, and its portfolio and pipeline support. The company has steadily increased its dividend over time. Its payout ratio hovers around 50%, which we think is reasonable. Gilead is another stock on our more expensive side of this list. Although the 3.84% return is very nice to see. Plenty of room for them to grow, with the 1Y estimate also sitting at $90.63. In our opinion, this is a good pickup. Dow stock is trading 27% below our $72 fair value estimate. It's also one of our top 33 undervalued stocks for the third quarter of 2023. one of the largest chemicals producers in the world, Dow has carved out a narrow economic moat due to the cost advantages of its ethylene and propylene manufacturing operations in North America. The company has paid dividends of $2.80 per share in the last 3 years, which we expect to continue. WEC Energy Stock, the largest Midwest utility, WEC has built a narrow economic moat with service territory monopolies and efficient scale advantages. A warmer than usual winter in 2023 will provide an earnings headwind for the rest of the year. Yet we consider the firm's 65% to 70% payout ratio to be appropriate, given the high quality and stable nature of the company's regulated assets. And we think the company's management team has done an exemplary job of allocating capital. Another higher valued stock on the list, but with a fair 3.48% dividend yield. This is looking like a great pickup. The 1Y target projects a growth of around 10% also, which is very nice. The second cheap dividend stock on our list from the utilities sector, PPL. A holding company of regulated utilities in Pennsylvania, Kentucky, and Rhode Island. The firm plans to pay out 60% to 65% of earnings, which we think is appropriate, given the high quality, stable nature of its regulated business. We expect the balance sheet to remain strong, too. With its cheap price and impressive 3.56% yield, in our opinion, this is looking like a strong pickup. 1-year target isn't looking too bad either, sitting at $31.09. Kellogg stock completes our list of cheap dividend stocks. Kellogg is also among our top dividend stocks to buy in 2023. Kellogg is a household name that has carved out a wide economic moat, thanks to its cost advantages as a leading packaged food manufacturer. We think the firm's balance sheet is sound, and we expect Kellogg to grow its dividend at a mid-single-digit pace annually. Like most other stocks on our list, Kellogg's is sitting at the 3.51% mark for dividend yield. With a fair price of $67.73, the first-year target, however, is looking a little low. Regardless, we think this is a good pickup for dividend yields. Choosing the right dividend stocks is essential for achieving your income goals. Look for companies with a history of consistent dividend payments and a strong financial track record. Blue-chip companies, often found in well-established industries, are generally known for stable dividends. Conduct thorough research to ensure the companies you select have a sustainable business model and a history of increasing dividends over time. One of the most powerful strategies in dividend investing is dividend reinvestment. Instead of taking the dividends as cash, reinvest them to purchase additional shares of the dividend stocks. This process of compounding allows your investments to grow exponentially over time, accelerating your income generation. There you have it, a roadmap to making $100 a day with dividend stocks. Dividend investing offers an incredible opportunity to build passive income and work towards your financial goals. Remember to research thoroughly, select the right dividend stocks, diversify your portfolio, and embrace the power of compounding through dividend reinvestment. If you found this video helpful, don't forget to like, comment, and subscribe to our channel. Share this video with friends and fellow investors, and let us know your thoughts and experiences in the comments below. Until next time, happy dividend investing.